David Tompkins. I'm a pensioner member of the fund, but I'm also, having very unfortunately been transferred out of local government 9 years before I actually retired, into a private company. I'm also a trustee of a very small pension fund. I've recently been involved in a lot of negotiation about recovery plan with our small pension fund, and I was very interested in the comments that Dave Wilkinson made about the recovery plan for this fund. What general structure does that recovery plan have? Because over 20 years you could have something that is very top-end weighted, meaning that the employer doesn't have to pay very much in the first few years, but pays a large amount towards the end of it. What does our recovery plan look like?
Okay. Do you want to say on this?
Yeah, we have used phased increases in employer contribution rates in the past. In 2007, when we looked at the deficit position, we didn't allow employers to phase their contributions. We divided the deficit by the recovery period, and they actually certified cash payments, not percentage of payroll, because percentage of payroll fluctuates, but cash deficit payments over 21 years, increasing by inflation year on year.
Thank you very much.
Okay. Yeah. Next question.
Just one question.
Gentleman down here. Yeah. Yeah.
David, please. Not on. You mentioned that the increase next year will be 3.1%. Going back to the situation last year, the pensions were frozen at the rate they were at. Will the increase be at that frozen rate or at the rate that would have been paid had the lower RPI been awarded?
Still be negative.
It will be 3.1% on the pension in payment now.
Right.
So we won't artificially reduce this current pension to what it would be by negative inflation and then apply 3.1. It will be 3.1 on the payment in pension now.
You know the way my mind works.
I know how your mind works, Keith.
Next one. Yes. Microphones on each way to you. Gentleman out there next. Yeah. Okay.
It's Peter Thomas. It's a really question, I think, for John Hattersley, because it's relating to some of his slides. On the slide relating to average asset allocation, I noticed that the typical, the alternatives seem to have reached more prominence in the last 4 years or so. They ran at 1 on an average along the line until you reached 2006, and then they began to rise quite significantly. So that the SYPF profile on that particular page is 8 for alternatives and 9 for property, so not very much, only one difference of 1 between the two. But then when you look at the back page, or at least back page of what I've been given, which is the last slide, so where's the fund now? Alternatives are 3%, but property's 10%, so that seems a slight discrepancy between the two slides. I wonder if you'd like to comment on that, and also on what alternatives are anyway.
Yes, certainly, that's part of the answer to the question. If you look at the slide saying where we are September, you'll see there's a heading called private equity there, which is 6%. Now, there isn't a heading called private equity on the WM slide showing the average local authority allocation. That's because WM put private equity and what we call alternatives together as one. So, in fact, the alternative allocation you're shown there of 7 for the local authority average equates to our weighting at the end of September of 9. Now, why? What does that comprise of? Private equity is long-term investment in unquoteds. The idea is that you invest in a company which doesn't want to be listed for whatever reason. You go in there with a specialist manager who either has a particular acumen on that industry or that sector, or can run businesses with a particular expertise. You are tied into that investment for a period of time. Normally it's at least 5 years. Average is about 7. But over time, you get a much better return than you do from public equity if you make the allocation correctly. Alternatives can cover a myriad of names. Normally, you would say they would be called hedge funds, but it also includes funds which specialize in insurance policies or in sectors such as bank loans, or it would include things like art or commodities or wheat or whatever you want to call it as an alternative. Why has that allocation increased over time amongst pension funds? Well, as the volatility of returns from conventional investments has grown, and it certainly has, we just, as I said, the range of values from equities has gone up and down tremendously over the last 5 years. People have been looking for more continuous income. You can't get that from bonds particularly because the yields are so low. So you're looking for an alternative income source. And one of the benefits of computers, if you want to put it that way, is it is now much easier to manage these sort of intangible assets than you ever could before. So not only can you actually get access to them, but you can manage them in a real way. You can monitor their performance. So alternatives have an attraction to a conventional pension fund in that, again, it doesn't work to the traditional cycle. There will be years when they outperform, when others underperform, and vice versa. So it gives you a diversification of risk. It's also a means of trying to access return which you can't get from conventional equities. It will have swings and roundabouts approach.
I think there was a gentleman there just in front of the screen, I think, was the first one, and then someone else. Yeah, thanks.
Keith Harding. I'm just interested in what happened with the Icelandic bank investments that the authority made, and in actual fact, did the authority get all its money back in view of the fact that the Icelandic government said they weren't going to pay it?
There's a lot going on since last year. I'll ask John to pick that up, but I mean, some of it is back, but not all of it, and it will be a long, long time before it is. But John, do you want to just give the latest position, please? Yeah.
They were not, sounds pedantic, but they were not investments in Icelandic banks. They were deposits with Icelandic banks. So it was not that we were a shareholder, we were a creditor. Now, the authority's position was it had investments in 5 banks with different time periods. The bulk of the money was with Glitnir. The rest of the money was Landsbanki and the UK subsidiaries of Landsbanki and Kaupthing. Now, the recovery of the UK subsidiaries is on track, and we've got about £3.4 million back out of that. The position with the 2 Icelandic banks is far more complicated. Along with many other local authorities, we are in a group being administered by the local government association who have hired specialist lawyers to litigate on our behalf in Iceland. And all the claims have been lodged with the Icelandic courts. The winding up board of Landsbanki has taken a different point of view from that of the winding up board of Glitnir. Landsbanki has accepted that local authority deposits are priority customers. Glitnir has not accepted that argument, and those cases are likely to come through November through to January 2011. Now, depending upon the outcome of those cases and whether local authorities do get priority status or not determines how much of the money you're going to get back and when you're going to get it back. So at the moment, I can only say that we've got about £3.5 million back. I don't know when or how much we're going to get back from the other deposits.
I think there was somebody down here, I think, wasn't there? I'm in the right order. I think it was you next to the lady here. And then I think the gentleman there, I think, yeah. Okay. Yes, on this one, yeah. Thank you.
Hello, Sheila Querney. I'm actually a current scheme member. I'm paying additional voluntary contributions, AVCs, and it's really just an opinion from the panel. Do you think that this is still an advisable thing to do in view of all the changes that are coming in, or not?
I think John will give the Financial Service Authority answer that we're not registered to give financial advice.
I was going to say that.
Having said that, each person's own financial circumstances are unique to themselves. You clearly, or I assume you are clearly paying additional voluntary contributions in order to top up your pension benefits. And one of the ways that you can use your additional voluntary contribution pot is to take it as cash and therefore not have to convert part of your pension into cash when you come to retire. So as a basic investment opportunity, there's nothing wrong with that. How much return you're going to make is anyone's guess, but it's a personal decision. It's for your own circumstances, and it's no different to you putting money in a building society and expecting a return on that at the end. It's tax advantage for you, and the costs that are taken out of that investment, because it's being done on a group basis, are much smaller than it would be if you tried to do it yourself. So I wouldn't suggest either way to continue or to pull it out.
You should be a politician, dear. I think. Yeah. I think the gentleman with the green, I think, was the next. Is that right? Shout if I miss anyone, and I've got a gentleman down here coming up. Yeah.